Should you keep renting or finally buy a home in 2025? With interest rates still high and affordability stretched thin, it's a tough call, but there are smart opportunities if you know where to look. In this video, I'll help you break it down and figure out what makes more sense for your situation and how to get a better deal if you decide to buy. First, I want to make sure to acknowledge that homeownership is a dream for many people, but it's also a major financial decision. So let's break it down logically so you can feel confident whether you choose to buy now or keep on renting. I want to start by going over what the pros of renting for one more year would be. First is flexibility. It's easier to move for a job, a relationship, or a lifestyle change. Then there are lower upfront costs. You don't have a down payment or closing costs, which can be thousands upon thousands of dollars. There's also less responsibility. The landlord handles maintenance and repairs. Being a homeowner is wonderful, but it's a big responsibility to keep up with all the maintenance and repairs, especially if you buy an older home. Then there's a potential that you could save more money. You could rent for another year and build a larger down payment or pay off any debt that you might have. I think renting makes sense if you're unsure of where you'll be in the next 1 or 2 years, you need time to build credit, pay down debt, or save more money. Or maybe you want to wait for lower interest rates and believe that they're coming. Which at this point, I don't know if I'd count on lower interest rates happening anytime soon, but you never know. Now I'm going to go over the pros of buying now. When you buy a home, you're building equity. Mortgage payments means growing ownership. If you're not familiar, home equity is the amount you own outright in your home, representing the difference between the property's current market value and the outstanding balance on your mortgage. It essentially reflects the portion of your home's value that you've paid for and now own. Another pro is locked-in housing costs. Assuming you get a fixed-rate loan, which I would recommend for most people, that means you'll have predictable payments. Now, property taxes and home insurance can and will change, but your principal and interest will stay the same. There are tax benefits. Mortgage interest and property taxes may be deductible, but obviously consult a tax professional because I'm certainly not one. And with being a homeowner, there's essentially a forced savings component. Your mortgage builds wealth over time. So basically, with home equity, if you're in a tight spot, you could borrow against the portion of the home that you own. However, I don't recommend doing that, and I would definitely caution against it, but there are situations where times are tough and people need to do that. So at least as a homeowner, you would have that option. Another pro is that you avoid future appreciation. Home prices are still rising in many markets, and markets that aren't rising right now, the theory is at some point they will. So the idea is that prices are always going to get higher as time moves along. That's kind of the working theory, but obviously there are exceptions to that rule. Ultimately, I think buying makes sense if you're financially stable and you plan to stay in the home for 5 to 7 years minimum, you qualify for a good loan or down payment assistance, basically you're financially ready, have a decent credit score, all that kind of good stuff. Also, if you want to lock in pricing now before further appreciation happens, especially if you're in a market that still has rising home prices. You can go to my website at workwithdang.com for free resources like a quick start home buying guide and a home buyer's course. I can help you find a real estate agent in your area. There's more information on my website. Now I want to break down and compare financially what makes more sense, renting versus buying. If you go on Google, you'll see that rent, as of this recording, is around $1,800 a month, which is a national average. So what you want to do for yourself when you're trying to determine if it makes financial sense to keep renting or to buy is to look at what your rent is in your area. When I check what mortgages are nationally averaging, Google says it's around $2,700 a month. However, there are a lot of variables there, so I'm going to break that down a bit for you. You can use a mortgage calculator. I use mortgagecalculator.org. What I did was use a base home price of $300,000. Of course, in your situation, you'd want to put in the amount that fits your area and the kind of home you're trying to buy. Prices can vary quite a bit depending on where you live and what kind of home you're looking for. So in this example, it broke down to $2,238 a month. At that point, using those numbers, renting might make more financial sense than buying, but I want to break down that $300,000 home example for you. In the mortgage calculator, I entered 10% down or $30,000. 10% is kind of the average that people are putting down on a home right now. But again, that's different for everybody. What's important is that you figure out your loan amount. In this case, the loan amount is $270,000. I set the interest rate at 6.75%, which is kind of the average right now for a 30-year term loan. I also selected a 30-year term because that's the most common. You get a lower monthly payment that way. So breaking that down, your principal and interest would be about $1,751. But with a mortgage, there's more that you pay besides just principal and interest. One of those is PMI. PMI stands for Private Mortgage Insurance. It's a type of insurance that protects the lender, not the borrower, in case of default on a conventional loan when the borrower's down payment is less than 20% of the home's purchase price. If you're getting an FHA or USDA loan, they have their own version of PMI. It's just called something different, but it's the same idea. For this example, I estimated PMI at 0.5%, which is kind of the average. That came out to be about $112 per month. Then for insurance, I put $1,500 a year, which breaks down to $125 a month. This could be low depending on where you live, so I'd recommend researching the average insurance cost for your state and plugging in that number. For property taxes, I estimated $3,000 a year, which is $250 a month. Again, check for your area. Taxes can vary quite a lot depending on your location. So when you add all of that together, you're looking at around $2,238 a month. That's about $400 more than the average rent. So as the kids might say, the math ain't mathing for buying a home, at least based on monthly payment alone. But here's the thing. While renting may save you a few $100 a month right now, buying can still win over the long run. If you stay put and build equity, you could walk away with tens of thousands of dollars in value 5 or 10 years down the line. That's money you won't see back if you keep renting. Another thing you also have to consider when you're doing these calculations is whether you have an HOA. If you do, you'll want to include that in your monthly budget. And you absolutely need to think about budgeting for maintenance. Most experts recommend setting aside 1 to 3% annually on your home's value for upkeep. So in this scenario, with a $300,000 home, maybe you try to save around $250 a month for any maintenance or repairs that come up. It's not just about the monthly payment, it's about what you're getting in return. Although you may be paying more each month with a mortgage right now, there's freedom that comes with homeownership. And depending on how rent trends in your area, there could come a point where your mortgage is actually less than what you'd be paying in rent. Now, I want to talk about some opportunity strategies in today's market. Even though interest rates are high, there are still chances for buyers to get a good deal, especially if you approach things strategically. Some of the things I'm going to go over really depend on where you're looking to buy. Real estate is hyperlocal and varies quite a bit, but there are markets where price reductions are happening. In some places, homes are listed for less than they were over the past couple of years. Inventory is still tight, but it's rising slowly, and homes that have been sitting on the market may become negotiable. What I've noticed is that late summer into early fall, say August or September, can be a great time to buy a home. Sellers who didn't get offers earlier in the year may be more motivated. Less competition means more negotiating power for you. So here's how to spot potential deals. Look for homes that have been sitting on the market for a while. What counts as a while really depends on your market, but start by checking out homes that have been listed for more than 30 days. Watch for price drops. Talk to your real estate agent about writing offers that include seller concessions, like seller-paid closing costs, rate buydowns, home warranties, or post-inspection credits. Now let's talk about the buy now, refinance later strategy. Some real estate agents suggest buying now with the idea that you'll refinance when rates drop. This can be a good strategy if you can comfortably afford the current monthly payment, if you find the right house, and if you plan to stay there long term. But I do want to raise the caution flag here because no one can guarantee that interest rates are going to drop. If rates don't drop or only drop slightly, you need to be prepared to live with your current mortgage. Don't buy a home assuming a refinance is coming. Buy assuming that your current rate is your forever rate. So what actually makes more sense right now, buying or renting? Let's break it down based on what we're seeing in the 2025 market. Affordability is tight. Prices are still high in many areas. Interest rates have been holding steady around 6.5% to 7%, which means monthly payments are high. Rent might also be rising in your area, but for a lot of people, it's still cheaper month to month than buying. There's also economic uncertainty. Potential tariffs, inflation, rising credit card debt, all of that adds some risk. Waiting another year might give you more clarity, but again, that's not guaranteed. That said, there are strategic buying opportunities if you're patient and smart about what you're looking for. Here's the bottom line. If you're not 100% financially stable, unsure about your job or location, or you need more time to save, then renting for another year is probably the better move. But if you're ready to buy and you approach the market strategically by targeting price drops, negotiating terms, and planning for the long term, you can still win in today's market. Whether you decide to rent for another year or buy now, what matters most is that it fits your goals and your budget. Don't rush this decision just because you feel pressure. Do what's right for you. If you think a USDA loan could help make buying more affordable, watch this next video where I walk through the eligibility rules and how to find USDA homes. Please like, comment, and subscribe if you've gotten any value from this video. It helps me out a lot.